Hi everyone. So today we are going to discuss some of the building blocks of how do we trade. These are some of the very important things you need to understand and know before you can start understanding what the information the Discord server is giving to you and how to parse that information. All right, so let's begin. The tools that I'm using here, the indicators, I'll make a separate video on how to set these up. But for now, let's just concentrate on the concepts, and we'll see how they all come together in different videos. Also, in this video, I'm not going to share anything about strategy. We are just discussing the building blocks of how to understand the information that is presented to you on the charts. So the first thing we want to discuss is an order block. If you look closely, an order block is basically an engulfing candle. You can see an example here where this up candle was completely engulfed by this orange candle. So this up candle was completely engulfed by a orange candle. Everything that I'm going to show you here will have a bullish counterpart and a bearish counterpart. So whatever you see here, just flip it around and you'll get to the other part of it. Let me draw some more examples of order blocks. So this is another order block. This is another order block. And this is another recent order block that was broken here. So something important to understand, let me just get this out of the way. If you focus your attention to this order block, let me remove this one and this one. The proper way to draw an order block is to take if you're drawing a bearish order block, the proper way to draw that is using the highest of the two highs that are available to you and draw it from there, because the entire range, this entire range is considered the order block, and obviously the bottom of the order block is the entire candle that was engulfed. Something important to understand, that an order block is not a valid order block if the entire candle is not engulfed. It has to be, you can see that the entire candle was engulfed here. For example, I wouldn't say that this blue candle engulfed this orange candle, because it was not completely engulfed. So this is not a valid order block, while this is a valid order block. And you can see the same thing here as well. This blue candle was completely engulfed here, then this blue candle was completely engulfed by this candle. So these are all valid examples of order block. However, you can see here that if I were to draw an order block here, this orange candle did not completely engulf this blue candle. So in the strictest sense, this is not an order block here. Another important concept in the order block theory is called a rejection block. What a rejection block is when the wick of the order block is completely unmitigated. So what do I mean by mitigation? So for example, let's just quickly understand mitigation. I think that's a great concept as well. Let's say this was an order block, and I'll just replay the time till here. So when you woke up, something like this had formed on a daily chart, a down candle which is completely engulfed by an up candle, which is a good order block. Now when the next candle prints and it comes down into the order block and then either continues to go down or comes back up, this is basically called mitigation. So this order block, or imagine all the sellers here when they were trying to sell in this candle, in this orange candle, they were very happy, price was going down, but the very next day they were all surprised, price just shot back up, and in such a way that every seller who started selling here got completely proven wrong. So now they're all in loss. That means they have to now mitigate, and this is where they mitigated. So when the next day price opened over here, price came back down, they all exited their positions, they're all loss making sell positions, and mitigated, and then the price came forward. So this is called mitigation. So why am I showing you why is understanding mitigation important? Going back to our example of what really is a rejection block, let me open up rejection block. And you can now clearly see. So this is an order block. The way to find a rejection block is this is an order block, and then this is the unmitigated part of that rejection block, of that order block, which is the wick. So if a wick is not mitigated to the 50%, it becomes a rejection block. And you can see there are many examples here. For example, this is an order block, but you can see that the wick in this order block is not mitigated to the 50% of the wick. Hence, this is a valid rejection block. Let me show you another example. This is an order block. This is an order block. And within this order block, since this wick is less than 50%, so 50% mitigation of this wick would be here. If this is not less than 50%, more than 50% mitigated, then this is a valid rejection block. Now, in itself, rejection block, order blocks, or anything else that I'm going to show here is not going to make sense to directly trade from, but combining these building blocks with other lower time frame concepts gives us a very powerful way to understand what the market is, anticipate what the market is going to do. Let's go on and see the next concept, which is fair value gaps. So fair value gaps are very interesting concepts in a way, and they help us understand the market dynamics. The way they work is that to understand a fair value gap, what you need to know is that there are three candle formation. You need candle 1, you need candle 2, and you need a candle 3 for a complete fair value gap to form. And the way it forms is when this is candle 1, candle 2, candle 3. When the low of the candle 1 does not overlaps with the high of the candle 3, then the gap that is created in candle 2 is called a fair value gap. So you would draw it something like this. And the way to understand this is between these three candles, there was so much bullish pressure that this candle could not even come back to here. And you can see they don't form every day, especially in ranges. You can see that almost all candles have an overlapping candle 1 with candle 3, overlapping candle 1 with candle 3. That's how an efficient market would trade. But when a market has an inefficiency, that's when fair value gaps are formed. Another example would be this. There was so much bearish pressure here that the high of this candle could not touch or overlap the low of this candle. Obviously, we're just flipping, you flip the concept of a bullish fair value gap and you get a bearish fair value gap, but the same concept applies here. So that's fair value gaps. Now let's also look at pivots. So what exactly is a pivot? Pivot is a formation where you will see that you'll have candle 1, candle 2, and then candle 3. This will create a bearish pivot, and then candle 1, candle 2, candle 3. This will create a bullish pivot. So these are again 3 candle formations where minimum 3 candle, you can have as many number of odd candles connected to form a pivot. And you can see the examples clearly here that when this pivot was formed, this candle is below this candle, and then this candle is below this high. So this is a pivot. Another pivot is here, where this is the low. So this is higher, lower, higher. So that means this is a pivot. Same thing here. You can see higher, lower, higher. This is a pivot. Higher, lower, higher, lower. This is a pivot. So in essence, by themselves, pivots are not that useful, but as you can very clearly see, they help you understand market structure. Let me go back in time where this was very clearly visible. Focus your attention here, that this was a pivot that got created. Market came down, made the lowest point, and then went back up. But then when market crossed this, broke this pivot, closed beyond this pivot, this is a significant event in the market, that they took out a pivot. And same here, we had a pivot. So this is what is called a pivot crossover, where you had a high, then higher, and then lower. So this was a pivot, and then there were 3 pivots right next to here, and then market took out, crossed over this pivot. Obviously couldn't continue. That's a different market dynamics altogether, but this is called a pivot crossover. Let me show you another one. Over here, market created low, lower, and then higher. So this blue candle created the pivot, and then market closed beyond the pivot, and you can see how significant that event was. Same here, market, so higher, lower, higher, that means this is a pivot. Market closed beyond, important point to remember, closed beyond the pivot, and then you can see how significant that event was. So the information that we derive out of the pivot is the market structure. We don't have to, if I basically just turn this off, you still see the same chart, but it's so hard to understand. And now you can very clearly see where the market is creating highs, where are the lows, where is it trying to break structures, etc. So I use pivots to clearly identify market structure. And now that we know that crossovers are important to us, we can plot them. And this is the best part. It gives us a very clear understanding of how we could use market structure to not only understand which side the market is breaking, but also to understand how do we position risk. So hypothetically, if I wanted to take this trade, I mean, I'm not saying go and take this trade, but if I were to, then I could just basically hide my stop loss behind that pivot high and trade below. So we'll get into the trades later. This is not a strategy concept, but the understanding I'm trying to give you here is, as we discussed, this was a pivot low, and when market broke over this, closed beyond this, we created a pivot crossover. And this is how the pivot crossover signal looks like when drawn. So this pivots and crossover indicator will give you this information. Now, I want you to, let me just turn the boxes off. Another very interesting information that pivots give us is called understanding of liquidity. And I know we have a plugin for that, and I'll get to that in a second. But think about it like this. Let's assume the price was here, okay? And it's very hard to understand, you know, where is liquidity in the market if you're just looking at a naked chart. But if we are able to plot pivots, then we can very clearly see that here are a bunch of equal highs just sitting where people are trying to hide their stop losses. So is here. And this is the beauty of using pivots. Now, we don't have to do this by hand. We got a plugin to do that, an indicator to do that. And there are many strategies how you could understand the concept of liquidity, but what this indicator, liquidity indicator, does is that it plots for you all the areas, pivot highs and pivot lows, that were not taken out by price. You can clearly see when price closes beyond them, obviously they'll be deleted, but if it just wicks below them and then moves on, you can see they'll be clearly drawn on the chart. But this is a very clear depiction to you that how and where people could be hiding, retail traders could be hiding their stop losses. So let's see in our example what happens here. So just focus here. So I'll just play the price forward. And we know by our analysis that, you know, there's lots of equal highs which have not been taken out yet. So let's see what happens. Price goes up, takes out the sellers, their stop losses, and then see what happens. This is a stop loss hunt. And it does it here again, you can see. Lots of equal lows, takes out their stops of buyers, goes up, and then drops again. So liquidity helps you visualize very clearly that what are the areas in price which have not been visited, and where retail traders could be hiding their stop losses. And when we start integrating all of this information into our trading strategy, by default, by itself, liquidity analysis might not be so interesting, but when you start integrating this into a higher level strategy, that's where it really starts unfolding. Then the last concept I want to show you is understanding of a range. So we recently added this into our Discord signal, that the concept of a premium and discount. But I just want to reiterate that once again over here, is that when you're trying to evaluate, do you want to buy something or sell something, you need to know where they are in the overall range. For example, let's say if this was the order block we were trying to sell, it's a bearish order block, and by general common sense, we always want to sell high and buy low. But what does that mean? How do we know something is high and something is low? Because you could be selling from anywhere, you could be buying from anywhere. How do you know? How do you have the context of the fact that you're high or low in the chart? And this is where the range comes in. So if we were to draw a range, and the way to read the range is that this is premium or high, and this is discount. So you always want to sell in premium and buy in discount. And once you have drawn this range, then you know that any selling opportunity up here is going to be a better opportunity than a selling opportunity over here. On the other hand, any buying opportunity here would be a better opportunity than a buying opportunity over here. For example, somebody could say, oh, this is a bullish order block, but you can see what happened after that, because the order block isn't premium. So we don't want to buy here and we don't want to sell here. Let me give you an example of this. Let's see. Let's actually open up our order blocks. So when this order block formed, the operating range, you could say that was this. And obviously the order block isn't premium, and you can see there was an immediate reaction from there on. Price could not even come back to retest that order block. So this is just one example where, I mean, obviously our Discord bot already does all these analysis for you. You don't have to do it by hand. It'll automatically tell you that a signal is in premium or discount by calculating the range for you, so you can confidently take that trade. But if you were to do it manually, this is how you were to do it. So these were the different concepts. Just going again in a summary, an order block is when, let me get my pen tool out. An order block is when one candle is completely engulfed by the other candle. This would be an order block. It's a two candle formation. A fair value gap would be when one candle, second candle, and third candle, the low of this candle and the high of this candle do not meet. This is a fair value gap, and it's a 3 candle formation. I forgot to mention that when order blocks are formed, let's say this was a bearish order block. If it has a wick which is completely unmitigated, which is this becomes a rejection block. Then for pivots, for a pivot low, you need to have the lowest candle being flanked by 2 higher candles, so this thing becomes a pivot low. And when you have a formation like this, which is high candle flanked by 2 lower candles, this becomes a pivot high. And these are 3 candle formations. And once you have a pivot, then you can also have a crossover of the pivot, which can give you a trading of area to work for a trading signal. Similarly here. And then once you know the pivots, you also know the liquidity points where, so let's say this was a pivot. This is now a liquidity reference point. And retail traders might be hiding their stop losses behind this. So price can come in, dip below it, and then zoom back up. So that's all. We'll cover more concepts, more discussions in other videos, but I hope this video was helpful to you all. If you have any questions, please don't hesitate to ask in the Discord channel. Take care.